There are several components to your tax return that matter. You may hear of standard deduction, itemized deductions, adjustable gross income, modified adjustable gross income, earned income, dividend income, lots of different language that's used. What matters most to you, and what can you do about it? Join us on Consider This Program today. We'll discuss it for you. Good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Grant Soliven.
Hey, Grant is one of our lead senior advisors, manager of the planning operations team. There are 38 people in our little crew, if you will. And Grant is works right underneath Aaron Rayum, our director of financial planning, to make sure that we're all functioning in the same place. If you've listened to the show and you hear different voices, that's why. We bring the whole planning team on the show so that you can get to hear their voices, their thoughts, their experience in terms of what's going on. And today we are talking about probably the foundation of really what built the Financial Enhancement Group. So back in 1997, Don Hodson and I formed the Financial Enhancement Group, if you will. Don was an enrolled agent, dealt in the tax world, specifically with people who had tax problems, liens, things of that nature. And we started the function there. We began doing financial planning using outside money managers. The tech wreck hit, and I realized we could not nearly be as incompetent as the rest of the world, and proves out that we have not. So we started managing money internally in 2000, still with that tax wraparound, if you will, paying attention to what's going on. Now I spend my days in the legacy planning world, helping people understand how the Financial Enhancement Group can be successor trustees, how we can be trust protectors, what that means for their families and their estates. But it all revolves around understanding the United States tax code. And I'm going to give Grant the opportunity to kind of break down these four things for you. So Grant, first of all, I'll let you go ahead and start in, but you can go from there.
No, absolutely. And Joe, in this segment today, we really want to talk about a tablet that's made of gold. And you heard that right. It's your 1040. A lot of times we look at this as a one-hit wonder. I know I talk to my mother every year. She files hers, and she is the grumpiest individual you'll ever meet between February and March because she's getting this thing ready. But again, if you miss the tax planning opportunities that are there, you're leaving gold money on the table. And so if you start treating your 1040 like you do your investment statements, you get a lot farther and a lot more done for your financial future.
Now, why do you suppose? What would be your theory as to why people pay more attention to an investment statement than they do a tax return?
Oh, that comes down to education and how we've positioned it. So, Joe, there's very few people that love paying taxes. In fact, I have not met an individual.
I have one, but we'll leave Jason Chubb out of this.
Keep the names to the innocent. But yeah,
he's not innocent.
Oh, well, I have never met anyone that has voluntarily said, yes, I will pay as many taxes as they will tax me. And so it's painful. It's this document that brings us anxiety, stress. You know, that everyone's trying to squirrel back the money from or get that return check from the IRS. They don't want to write a check. And then we look at these investment statements, and Joe, this is our blood, sweat, and tears. This is what, my wife and I didn't go on an anniversary trip, so we could put money in our retirement accounts for our future. I mean, this was sacrifice. And so that would be my perspective. And honestly, I'm kind of cheating because I'm stealing it from some of the families we serve. These are the things they're telling me.
Grant and I both work out a lot, and obviously we eat a lot too. But we don't get weighed every hour.
Thank goodness.
What do you suppose would happen if we got weighed every hour?
I'd probably eat more, Joe, out of just stress and anxiety.
Okay. What I will tell you is that people have a propensity to believe that more data provides more knowledge, right?
Yes.
And, my friends laugh at me. Hey, 2008, 2009 was a horrible, horrible time. Try managing your in-laws' money in the middle of a Great Recession. I haven't watched the news since 2009. I accidentally watch it from time to time on CNBC. I mute it until one of my friends comes on or somebody that I think knows what they're talking about. But I don't hear the news, and I don't have the emotional ups and downs. And it's when I'm with my friends and I hear the frustration over Afghanistan or over whatever it is, it's kind of like, they say, how do you do it and not know? And it's kind of like, I pray hard, but I can't fix it. They won't give me a gavel. Right? I can't fix it, and all I can do is pray. I don't need to know and have my blood pressure raised like you're having that done. Folks, you're having the same challenge with your tax return. You get those investment statements because the old president of the New York Stock Exchange said that you needed to have those statements every quarter because Joe and Grant couldn't do their job if they only had access to data once a year. In 1994, by the way, that's all you got your 401k statement was once a year, right? Joe and Grant couldn't do their job, so we need to send it to you all the time. And you believe the more data you get, the better decision you can make. And I'm telling you, the more data I get about quilting or crocheting or oil changing or how the engine of my Jeep works is not going to help us, right? I mean, I can read it all day long. I have no talent, no skill set for that. I mean, just because you give me the data and say, okay, here's what it is. Here's the horsepower of your engine. Great. I don't know what it means, but great, right? That's the challenge. When you only get a tax return once a year and you file it after the fact, right? Your desire to look at it, to listen to it, to pay attention to it diminishes simply because you don't have access to it every day on an email machine or an internet machine. And I think if you looked at it more often, you would understand what Grant's talking about. Sorry 100%. I took so much of your time.
No, you're fine, Joe. You brought very, very valuable points because, again, that the tax return, all we associate is, I have to write a check to the IRS. And we forget some of the magical tools that this gold tablet gives us. For example, what is adjusted gross income versus taxable income? Why does it matter? Right? One's the rules of the sandbox. The other is how you play chess with the IRS, right? Another one, marginal tax rate versus effective tax rate. Why does the CPA give us one, and why does our tax planning team give us the other? And why are both important, and when are they important? Standard deduction versus itemized deductions. Understanding what the Tax Cut and Jobs Act did to the 1040, and understanding how that's important because, again, the big three that most people put on their 1040. Salt tax, right? Capped at $10,000. Itemized deduction.
That's state and local tax, guys.
Thank you. Yeah, and the mortgage interest, which for a lot of the families we serve, gone. And then your philanthropical needs or ideals. The standard deduction is raised too high, but then if we still are giving, there's this thing called deduction stacking. What does that mean? And then why is earned income important? We forget to evaluate these important little metrics and measures in your 1040, and Joe, it can lead to very disastrous effects. I mean, earlier in the year, we talked about, I'll never forget this, the lady that you were managing money, her husband was a professor at Purdue, and she wouldn't give you the 1040, and she left tens, maybe even hundreds of thousands of dollars on the table because she didn't understand these key elements. And not because she was a fool. She was not. It's just there's two tax codes, Joe, and you talk about this often. There's a tax code for, some of us think it's the tax code for the rich and for the poor. Couldn't be farther from the truth. It's tax code for the informed and the uninformed. And our job today is really to help inform all of you that this is not some document that you just throw in a cupboard and let dust collect on top of it. This is a gold tablet that you must keep in front of you all year for planning purposes.
Absolutely. So you said you laid out two terms, so let's hit those real quick. What is an effective rate?
An effective rate, Joe, is essentially your average tax rate across all the brackets. So our tax system, for those of you that may not know, is like stair steps. I could probably use some more stair steps in my workout routine, but we won't go there. So it's the bottom stair is 10%. Then the next, the time of this recording is 12, 22, 24, etc. And so depending on where you sit, what stair step you sit, all the way to the top of 37, your effective rate is the average tax dollar you pay across all the stairs you're sitting on.
The more money you make, the higher you pay.
100%.
Just the way that it's designed and the way that it works. But it doesn't mean that you pay all of your money at the top.
Correct.
You pay it on each step. So me, you, Warren Buffett, Grant, assuming we have taxable income, and not everybody does, that's where you get into that political battle. It's about 50% of the America does not pay any money at the marginal rates, or what we're talking about is effective now. He's going to give you marginal here in a second. But once you made enough money that you get to those stair steps, I pay money at that 10% bracket, then I pay money at the 12% bracket, then I pay money at the 22% bracket, etc. So that is the effective rate. What's marginal?
Marginal rate, Joe, is the top of the stair that you're earning income on. So, for example, at the time of this recording, married filing jointly, the top of the 12% tax bracket is $81,050. Meaning, if you take your adjusted gross income, you subtract your standard itemized deduction, as long as your income's below $81,050, then you're in the 12% tax bracket.
So our objective, married filing jointly, when I sit down with people in Indiana, it can't be true for our California families always, but our objective is to try to get you to a standard of living that has taxable income of $106,000. That way we keep you in the 12% bracket. And I will tell you, in 35 years of being in this industry, people will talk about markets, ups and downs, the Great Recession. I've been through more volatility than anybody who lived through the Great Depression. Ladies and gentlemen, there is nothing I've seen separate you from your retirement like the Internal Revenue Service. If you do not understand tax planning, it will get you. 800-928-4001. Go to yourlifeafterwork.com. Get signed up for a Next Steps meeting.